graphics on, just so we can see whereabouts we are situated in regards to yesterday. So we can see that I'm on a 1 hour time frame. I'm quickly going to drop it to half an hour.
Right, good morning then, folks, as we head into European trade on Thursday the 7th of September. We'll across to the calendar and have a look at the data yesterday. We obviously had services PMIs out of the US, which came in higher than anticipated, and also the Bank of Canada confirming their pause on hikes and alluding to a period of slow growth within the economy, which is likely to be a theme going forward. Apart from the US, which are doing alright, but the rest of the countries still seem to be struggling somewhat. You can see Japanese stocks snap 8-day winning streak on rates, and China worries snapped an 8-day winning streak on Thursday. Earlier, as rising US yield and a slowing Chinese economy set momentum from the markets rally. But Japanese stocks continue to rise more than global stocks, obviously due to the fact that the Bank of Japan continue with their ultra-loose monetary policy, while countries around the world continue to hike interest rates, or certainly have high interest rates and may potentially look at hiking them, or some are going on a pause, but minus 0.1% interest rates are a lot more favourable for business conditions than 5.5%. So Japanese stocks continue to have a good time of it. But apart from that, it's kind of a bit little wishy-washy pieces. I mean, investors' China aversion is bad for everyone. Opinionated pieces still in the low rates and yields world. And talk about European private loans, kind of in the global market sections. I mean, dollar to stay bright this year before fading in 2024. China's yuan hovers at 10-month lows. Economic worries persist. This is all information we know. It's not exactly much new information out apart from the calendar as of yesterday. Now, stock index is lower across the board. You can see US, European and Asia Pacific equities red across the board. That goes in line with the negativity we saw from the higher than anticipated US data yesterday. Now, is that likely to cause the Fed to hike interest rates? No. Is it likely really to change their stance in any way, shape or form at the next interest rate decision? I would suggest no, but markets have certainly not taken that positively. Yields slightly lower on the day today, but they popped higher yesterday. Helps to send equity futures lower. Not clear risk off trading. As if it was clear risk off trading, you'd see bonds purchased, yields sold off, and you see your Aussie and Kiwi down with that. But your Aussie and Kiwi have bounced back overnight, maybe somewhat surprisingly. I may have missed something personally, but really it's not often you see the Aussie, Kiwi and the Japanese yen all relatively strong. The US dollar strong to mix, but really it had a bit of strength in the US dollar yesterday. It has pulled back slightly, but stock index downside, really what we saw post releases yesterday. As you can see, the services PMI beating consensus by nearly 2 points, beating previous, and shows growth within the services sector. And you see that has remained relatively strong for months. It has remained above 50 since December of last year. It was pretty low, below 50, but every month after that has been positive, and it's on a little bit of an uptrend now. Again, a resilient US economy, which is likely to be supportive for the dollar going forward, certainly until the economy turns around, or if it does in fact turn around. And then maybe potentially look at rate cuts next year, but we'll cross that bridge when it comes to it. The US economy is still performing better than really any other economy in the G8 space. In terms of data overnight, then trade balance figures out of China, which do not make for good reading. You can see consensus was for a surplus of 73.9 billion. That surplus dropped. Missed consensus by 5 billion, and then missed the previous by about 12. Exports and imports both down. They're down last month, both of them down this month, both of them. Yeah, and it's not exactly positive. A little bit better than the previous month, though. They're down double digits last month, single digits this month. Slightly beat consensus as well, but they're still down nearly 9 and 7.5%. So certainly not positive reading from China again this morning, which is persistent worries about the Chinese economy. You have a look at data, many data recently from China. It's not been good reading, as we keep alluding to on these videos. Apart from that, house prices in the UK down again. It's fantastic for the economy. For people looking to buy houses, the more they can keep coming down, the more positive it is for people looking to buy homes. But does that really impact the markets too much? Not really. Some GDP figures from Europe. They would usually be high impact, but it's the third estimate of the quarter of the Q2 figures. So consensus 0.3 versus and 0.6 for the quarter-over-quarter, year-over-year figures. So no likelihood of recession. They avoided growth. I say avoided growth. Technically, they avoided growth, but they avoided contraction as well in Q1, Q2 this year, to avoid contraction as well. So slight positive for the European economy. Not exactly performing at the same rate that the US economy is. So IB PMI from Canada. Central bank suggesting yesterday they're going through a period of low growth. Any weak numbers will likely mean the Canadian dollar is sold back into any strong numbers. It doesn't really go in line with the central bank's thinking. So you'd be hoping for weak numbers going forward out of Canada. You've got oil inventories today, usually on a Wednesday, but today being Thursday due to the bank holiday Monday, shifted a day forward. So keep an eye on those oil inventories, especially after last week's big miss, minus 10.5 million barrels of oil, especially after Russia and Saudi Arabia continuing with production cuts through to year end. If supply keeps decreasing in the US, should keep pushing the price of oil higher. So something definitely worth keeping an eye on this afternoon as and when the figures come out. But apart from that, moving on to markets, you can see equities starting to roll over again. End of Asian session, heading into the European session today. You can see the S&P, the Dow Jones, the Nasdaq and the Russell all turning lower. You can see the DAX, the Euro stocks, the FTSE all turning lower. There's negativity across the board in stock indexes, going in line with recent trends. Also going in line with that strong economic data from the US yesterday. That's a reason to continue that trend. Let's see if that trend continues into today's European session. But all these stock indexes are pointed lower. When that happens, you'd rather be a seller. When all those stock indexes are pointed higher, when that happens, you'd rather be a buyer. US dollar did strengthen off the back of the release yesterday. Not as much as you may have hoped from the release yesterday. You can see the Aussie, Kiwi, Euro and Sterling. They're all relatively mixed. Sterling had a bit of a sell-off, kind of 2-3 o'clock yesterday. But obviously with this economic data yesterday coming out at 3 o'clock, he had one more spike lower on it there, and it's just chopped sideways since. Spike lower there on Euro dollar, chopped sideways since. Same on Aussie, same on Kiwi. You had a spike lower, which is a spike higher in the dollar. You then see your dollar Swiss, dollar CAD, dollar yen, all of the same spike higher, but have just chopped sideways since. So market's still a little bit undecided on the US dollar, but it seems a bit of a more clear-cut picture when it comes to stock indexes. You saw a big downside across the board in stock index, bit of a pullback into the close yesterday in the overnight session. They've rolled over again due to ongoing China weakness, rising yields, higher than expected economic data. It doesn't make the Fed hike interest rates. Does it increase hawkishness from the Fed? You'd have to imagine probably not, just off the back of that, but it means they're not going to be as dovish. We'll put it down to that. I mean, it's a bit wishy-washy analysis, but at the end of the day, multiple reasons for stock indexes to continue to head lower. Yields popping through the highs yesterday, as you can see, and maintaining that move above the highs. Oil had another attempt at the highs yesterday. We're looking at dips to be bought, maybe hoping to retrace the whole move and then buy the dip. So not managed to catch that yesterday. Apart from that, gold continues to trend lower with yields trending higher. So more yields push higher if yields continue to push higher. Gold shorts, dollar yen longs seem a decent bet, but dollar yen hanging out up here at the highs. Doesn't seem to really want to do much. I have to imagine it probably goes up and tests the Bank of Japan's resolve. Normally does when it gets to this level. So let's see what dollar yen has to say for itself. But failing to break through these highs at the moment. Still technically in your uptrend, so not too much to worry about now. Anything below 147, that's probably when you'd be looking for sales, maybe back towards 145, the figure. Apart from that, economic calendar for the rest of the day, I've already been through it. Oil inventories today, main focus of attention. I'm not personally going to care too much about the European data, but if you're a trader of euro dollar or the German stock indexes, something you are going to have to keep your eyes on. But equities under pressure as we head into European trade today. You'd imagine off the back of that the US dollar would want to push higher. A lot of that will probably revolve around what yields have to do. If yields push higher again, should be supportive for the dollar, and that will be doubly negative for equities as we head into European trade for today.
We're gonna quickly have a look at what happened. So basically, we have